Hey everyone, welcome back to Corporate Decoder. Today we're diving into the world of business development companies with Blue Owl Credit Income Corp's latest filing. Let's just say with $9 billion on the table, someone's been busy, but is it all sunshine and roses? Stick around and we'll break it down. First off, this is a Form N2, basically the registration statement for a business development company like Blue Owl. So what is Blue Owl Credit Income? They're not your average company. They're a business development company or BDC. They lend money to middle market companies, those businesses that are too big for small bank loans but not quite ready to tap into the big public markets. Think companies with annual earnings between 10 million and XM 250 million. And Blue Owl isn't new to this game. Since 2016, they've originated about 14.2 billion in investments. That's a lot of deals. Their bread and butter is making loans, but they also dabble in equity investments. Blue Owl's strategy is to generate income and some capital appreciation. At least 80% of their investments will be in credit investments, which means debt. XD company is selling shares at a price that reflects its net asset value. TAP the company is selling shares at a price that reflects its net asset value. Here's a big red flag. Shares of Blue Owl's common stock are highly illiquid. That's corporate speak for you're not going to be able to easily sell these. They don't intend to list on any exchange, and there's no guarantee they'll even repurchase your shares. So this is a long-term commitment. It's like checking into a hotel with no checkout date. There are three classes of shares: Class S, Class D, and Class I. Class S and Class D shares come with ongoing servicing fees of 0.85% and 0.25% respectively. There's an upfront sales load too, with a max of 3.5% for Class S and 1.5% for Class D. Class I, no upfront sales load too, with a max of 3.5% for Class D. Class I, no upfront sales load, no ongoing servicing fees. But there's one important condition: a Class S share and a Class D share will convert into a Class I share when the aggregate underwriting compensation is more than 10% of gross proceeds. What about leverage? BDCs are generally allowed to borrow up to DAXIF M4M for every Thesio 1 of investor equity. Invariate with of Blue Owl's board of directors have approved, but keep in mind that Borrow Bunny amplifies both gains and losses, so you can expect bigger swings. Speaking of risk, there are plenty of factors to keep in mind if you are thinking about investing in Blue Owl. Here's a few of the factors from the SE filing. The company may face increasing competition for investment opportunities. Their investment portfolio is recorded at fair value by their advisor. They may be obligated to pay their advisor incentive fees. Even if they incur a net loss, regulations may affect the way in which they raise capital, and 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 the way in which they raise capital. They are also exposed to things like reliance on information systems and related failures, the general market risks, and changes in laws or regulations governing operations. And to add on top of that, the notes that Blue Owl issues are unsecured, meaning that there is no collateral securing the debt. There's also a lot of uncertainty when it comes to the dividend payments. Portions of them may represent a return of capital. They may use sources other than cash flows from operations to fund distributions. You should understand that such distributions may not be based on our investment performance. So how have they been doing so far? Through March 3, 2025, they've issued a combined total of 1.76 billion shares and raised around 16.6 billion shares. And raised around 16.6 billion shares and raised around 16.6 billion shares. And raised around 16.6 billion shares. Where's all that money going? They estimate investing the proceeds from subscriptions within 30 to 90 days, focusing on originating loans. However, until they find those opportunities, they're sticking it in cash, government securities, and other low-risk options. As of the end of 2024, their investments break down mostly to first lien senior secured debt investments, followed by second lien senior secured debt investments, unsecured debt investments, joint ventures, preferred equity investments, and common equity investments. Their borrowers are usually companies in the middle with an average annual revenue of $1.09 billion and EBITDA of $263 million. They focus on service-oriented sectors like software, insurance, and healthcare. Now let's get to some numbers in the financial highlights. The total expenses was 9.94% for Class S. In addition, interest payments on borrowed funds was 7.59%. Now, depending on which class of shares you have, this may vary. So what's my take? Blue Owl is operating in a segment with a lot of tailwind for it right now. Private credit is becoming more attractive relative to traditional methods. Even though this SEC filing looks scary, it's more that SEC wants you to be aware of all the risks before jumping into a decision like this. However, like a real owl, you will need to be wise to know if the business is right for you. There is almost no liquidity and they don't have a long history. So what do you guys think? Let me know what are your thoughts in the comments. Like this video if you found it helpful, and don't forget to subscribe for more deep dives into the world of corporate filings. And if you want me to do a deep dive in another sector, just let me know down below.